What if I told you that before every major market crash in modern history, the same three trades appear almost like ghostly fingerprints left behind by people who know what age is coming long before everyone else? Before 1929, when millions lost everything? Before 1987, when the market fell 22% in a single day? Before 2008, when the global financial system nearly collapsed? And now, before 2025, as new warnings flash again? A small group of investors quietly made moves that seemed strange at the time, but perfectly obvious in hindsight. What do these billionaires see that the average person never does? Why do they act early months or even years before the panic hits? And why do these three trades show up again and again and again? Hey, stay with me because today you'll discover the hidden playbook of the world's wealthiest investors. It's the same playbook they seem to use before every crash. Financial crashes look chaotic from the outside. Headlines scream, unexpected plunge, sudden collapse. No one could have seen it coming. But history tells a different story. Crashes have a pattern, almost like a heartbeat. They build slowly, accelerate quietly, and then crack suddenly when the public is most confident. Yet behind the scenes, the people closest to the machinery of finance, bankers, fund managers, powerful families, central bank insiders, global hedge funds, make moves far earlier than the chaos. Their trades reveal a simple truth. Crashes don't start with panic. They start with preparation. And that preparation begins with three quiet but powerful shifts. Before we reveal them, we have to go back. Because this pattern didn't start in modern times. It started nearly a century ago. The roaring 20s were booming. Stock prices doubled. Credit was everywhere. Newspapers promised everyone could get rich. But beneath the excitement, the earliest wealthy investors noticed corporate insiders selling rising margin debt, exploding banks quietly tightening credit, and a rapid disconnect between prices and real earnings. Then, trade number one appeared for the first time in recorded history. Trade number one. Billionaires move into hard value assets, not gold alone, but anything with real, measurable utility. Farmland, cash flow businesses, commodities, and yes, physical gold while the public bought stocks on debt. The richest investors rotated into assets independent of financial markets. This was the earliest sign, breaking point by late 1929. Insider trading at the biggest banks hit record levels. Credit froze. And on October 24th, the market collapsed. But the wealthy? They had already escaped the blast radius. The 1980s looked invincible. New technology, rising global trade, strong economic recovery. Stocks surged 40% in a single year. Once again, the public believed the boom would never end. But behind the curtain, the rich saw something alarming. Price turnings, ratios overheating, a massive surge in corporate buybacks, and new untested financial programs called portfolio insurance. As risks grew, billionaires quietly made their second predictable move. Trade number two, loading up on volatility and insurance. This didn't exist in 1929. But by the 80s, wealthy investors could buy put options volatility, futures hedging contracts, synthetic insurance positions. Before the 1987 crash, option volume tied to insurance exploded, but not from the public, from institutions with deep pockets. When the market dropped 22% in a single day, the wealthy were not destroyed, they were hedged. Once again, the same pattern appeared. Rotate into real assets, hedge aggressively to trades down. One more to reveal. 4. Breaking point, the 2008 financial crisis. This is where the pattern becomes impossible to ignore. Leading up to 2008, mortgage debt skyrocketed. Banks created weapons like CDOs and synthetic swaps, rating agencies rubber-stamped everything. AAA housing prices rose 80% in 4 years, but the people closest to the financial system saw the truth early. Michael Burry famously spotted it. So did Goldman Sachs partners. So did certain billionaire investors. And this is where trade number 3 appears with crystal clarity. Trade number 3. Billionaires move into maximum liquidity. Liquidity equals power. Right before 2008, Buffett accumulated record cash. Ray Dalio shifted into treasury-heavy positions. Global funds reduced long exposure. Insiders sold stocks at the highest rate since 1929. Why liquidity? Because when the crash comes, cash becomes a weapon. It lets the rich buy distressed assets at pennies on the dollar. This is how generational wealth is built. Liquidity is not safety. It's opportunity fuel. What happens after the crash? After every crash, the same outcome repeats. The public loses wealth, middle-class savings are wiped out. Retirement accounts fall, credit tightens, panic spreads, and recovery takes years. But billionaires, they buy the bottom. They expand, they acquire, they gain control of industries. This is not luck. It is not coincidence. It is a systematic, repeatable playbook. 6. Failed fixes: why the system never changes after every major crash. Government reforms promise, never again. Banks are restructured. New regulations appear, oversight is increased, speeches are made, and the system resets. But the same vulnerabilities remain. Leverage, speculation, bubbles, greed, weak regulation, and asymmetric information. The public never gets the warning in time, but insiders always do. And they continue repeating the same 3 trades because they always work. 7. Modern parallels: the 2025 warning signs. Let's fast forward to now. Look at the signals flashing today. Household debt at all-time highs. Global government debt at 107% of GDP. Record stock margin debt. Tech valuations reaching .com levels. Central banks tightening liquidity. Insider selling hitting a 24-year high. Billionaires moving into commodities. Farmland and private assets. Hedge funds buying massive put option positions. Corporate insiders hoarding cash. Sound familiar? Because we've seen all this before. 1929, 1987, 2008, and now 2025. And yes, the same 3 trades are appearing again right now. 8. The 3 trades final reveal. Trade number 1. Rotation into hard value assets. Farmland, commodities, energy, gold, private cash flow assets. Always the first shift. Trade number 2. Hedging through volatility and insurance puts. VIX exposure, short positions, layered protection. Always the second shift. Trade number 3. Maximum liquidity record, cash reserves, dry powder. Waiting for the discount of a generation. These 3 moves happen before the headlines, before the panic, before the collapse. 9. Conclusion, takeaways, warning, call to action. Crashes follow patterns, not chaos. The wealthy act early because they study the underlying system, not the headlines. Preparation beats prediction. You don't need to know the exact date, only the signs. Liquidity and positioning decide who suffers and who rises afterward. A warning: if these same 3 billionaire trades are showing up again in 2025, what does that tell us about what comes next? Asterisk, asterisk, maybe nothing, maybe everything. But history says, when the richest people on earth quietly reposition, you should pay attention. If you learned something new today, if this opened your eyes to the hidden patterns of financial history, hit like, subscribe to the channel, and turn on notifications, because in the coming months, I'll be breaking down each of these 3 trades, how they work, and how you can learn from them before the next shock hits. Stay aware, stay informed, and as always, think independently.